Hello, everyone. There is a market worth $3 trillion, bigger than the entire economy of France. 94% of the world's biggest pension funds and insurance companies are already inside it. And there is a very good chance you have never heard its name. It is not the stock market. It is not real estate. It is not gold. It is called private credit. And what is happening to this market right now in 2026 could be the most important financial story nobody is talking about. Stick around, because by the end of this video, you are going to understand exactly what private credit is, how it works, who has been profiting from it quietly for years, and most importantly, whether you, a regular investor, can actually get access to it right now. Let us start with the most basic question. What exactly is private credit? And I want you to forget everything complicated you think finance is, because this is actually very simple. You already know what a bank does, right? A company needs money. The company goes to the bank. The bank gives the loan. The company pays back with interest, and the bank keeps that interest as profit. Now here is the question nobody ever asks. What if you could be the bank? That is private credit. Instead of a bank giving the loan, a private fund or a private lender gives the loan directly to the company, negotiates the terms privately, collects the interest, and keeps the returns. No bank in the middle, no middleman taking a cut. Just a direct deal between lender and borrower. And because there's no bank involved, no public market, no stock exchange, no regulatory disclosure requirements, the returns are significantly higher. We are talking 9 to 13% target yields, according to data from JP Morgan and McKinsey, while your savings account sits at 4%. Now you're probably asking yourself right now, if the returns are this good, why would any company choose to borrow from a private lender instead of just walking into a bank? That question has an answer that explains everything about how this market became $3 trillion. Let us go back to 2008. The global financial crisis happened. Banks almost collapsed. The US government had to bail out the entire banking system with taxpayer money. And after that, regulators around the world said, never again. They passed something called Basel regulations, which forced banks to hold much more capital against risky loans. What that meant in simple terms, banks became dramatically more conservative about who they would lend to. Suddenly, thousands of mid-sized companies across America and Europe, companies doing $25 million to $100 million in annual revenue, could not get bank loans easily anymore. They were not big enough for the bond market, and banks were now too cautious to lend to them. So who stepped in to fill that gap? Private credit funds. And companies loved it, because private lenders offer three things that banks simply cannot match. The first is speed. A bank loan can take 3 to 6 months to approve. Private lenders can close deals in weeks for a company trying to close an acquisition or fund urgent expansion. That speed can be the difference between winning and losing. The second is flexibility. Banks have rigid, standardized loan structures. Private lenders customize every single deal. The loan terms, the repayment schedule, the covenants, everything is negotiated specifically for that company. The third is certainty. When public credit markets freeze, like they did in 2022 when the Federal Reserve was aggressively hiking interest rates, private credit kept flowing. Companies knew that even in the worst market conditions, their private lender would not suddenly pull out. And here is something that tells you everything about how powerful this shift has been. According to the Federal Reserve's own research, the largest U.S. banks extended around $95 billion in credit lines to private credit vehicles by 2024. The banks themselves started funding private credit funds because they realized they could not compete on their own anymore. Wells Fargo partnered with Centerbridge Partners. Citigroup partnered with Apollo Global Management. Barclays partnered with AGL Private Credit. Think about what that means. The biggest banks in the world are not fighting private credit. They are joining it. So now the question you should be asking, how did this market get to $3 trillion? And where is it going? In 2020, private credit was worth $2 trillion globally. By the start of 2025, it had grown to $3 trillion. Morgan Stanley projects it'll reach $5 trillion by 2029. Moody's says it could double to over $3 trillion in assets under management by 2028. And McKinsey Research says something even more staggering. The total addressable market for private credit in the United States alone could eventually exceed $30 trillion as more and more loans shift from bank balance sheets to private lenders. Now let me put that in perspective with something you know. The entire U.S. stock market is worth around $50 trillion. Private credit is already a significant fraction of that, and it is growing at 12% per year. But here is the number that should really catch your attention. Retail investors, people like you and me, currently have only about $100 billion allocated to private credit. That is $0.1 trillion out of a $3 trillion market. Wellington Management projects that retail allocation to private credit will grow at nearly 80% per year to reach $2.4 trillion by 2030. So ask yourself this: if this market is growing that fast, and regular investors currently have almost nothing inside it, where does that growth come from? And who benefits when it arrives? Now let us talk about the returns, because this is where it gets really interesting. According to McKinsey's 2025 Global Private Markets Report, the pooled net internal rate of return for private credit was 8.5% in 2025. For context, the 10-year average median return for private credit vintages from 2013 to 2022 was 8.8%. This is consistent, long-term performance. And when you compare it to other fixed income options, JP Morgan data shows the following annualized returns. Mezzanine debt in private credit, 11.4%. Direct lending in private credit, 9%. High-yield public bonds, 5.2%. Investment-grade public bonds, 2.4%. So the question is obvious. Why is everyone not putting their money here? And the answer brings us to the part that most finance channels skip entirely. Private credit has real risks, and you need to understand them before you invest a single dollar. The first risk is illiquidity. This is the biggest practical risk for everyday investors. When you put money into a private credit fund, you cannot sell it tomorrow like a stock. Your money is typically locked in for 3 to 7 years, sometimes longer. If a financial emergency hits, if you lose your job, if you need that money urgently, you cannot easily access it. This is not like a mutual fund where you can redeem tomorrow. This is a commitment. The second risk is default risk. Companies that borrow from private lenders are often mid-sized, and mid-sized companies can fail, especially in economic downturns. JP Morgan data puts the private credit default rate at around 2.5% recently, broadly in line with historical averages. But the Financial Stability Board, a global body that monitors financial system risk, made a very important note. If you include selective defaults and debt restructuring exercises, the true default rate in private credit is closer to 5%. That is still manageable, but it is significantly higher than the headline number you will hear from fund managers trying to sell you their product. The third and most important risk: this market has never been tested through a severe economic recession. Private credit grew up in a decade of low interest rates and economic expansion from 2010 to 2022. The market is now entering what analysts are calling its first real test. A 2026 Outlook report from With Intelligence, a leading financial research firm, put it bluntly: private credit enters 2026 facing its most challenging environment since the 2008 financial crisis. More leverage, more complex deal structures, more capital chasing fewer good deals, and a global economic environment that is more uncertain than it has been in years. So the honest truth is this: private credit has delivered impressive, consistent returns over a long period, but past performance is never a guarantee of future results. And anyone who tells you this is a guaranteed easy return, he's not giving you the full picture. Now, here is the part that will make you genuinely uncomfortable. Who has been making money from private credit all this time? The big players managing private credit funds are names like Blackstone, Apollo Global Management, Ares Management, KKR, and Blue Owl Capital. In the second quarter of 2025 alone, Ares Management had $150 billion in committed capital sitting ready to be deployed into private credit deals. And who gave them that money to invest? Your pension fund, the one managing your retirement savings right now, has been investing in private credit for years. Insurance companies, which hold the premiums paid by middle-class families, are heavily allocated to private credit. University endowments, sovereign wealth funds, and the ultra-wealthy. According to a 2025 Nuveen survey, 94% of institutional investors now invest in private credit. 94%. And retail investors, regular people, currently hold about 3% of total private credit assets. So here is the uncomfortable reality. Your own pension fund has been earning 9 to 13% returns on your retirement money by investing in a market you were never told about, while your personal savings sits in a bank account earning 4%. Same financial system, completely different access. But something just changed, and this is the most important development in this story. In August 2025, the Trump administration signed an executive order opening the door to alternative investments, including private credit, inside 401k retirement plans. For decades, 401k plans were restricted almost entirely to publicly traded stocks and bonds. That restriction is now being dismantled. Cleary Gottlieb, one of the most respected global law firms, said in their 2026 financial outlook, "This regulatory shift potentially unlocks trillions of dollars in retail capital that has historically been confined to traditional stocks and bonds. The wall that kept regular investors out of private credit is developing a very large crack." So how can you actually get exposure to private credit right now? There are 4 realistic pathways, and I want to be completely transparent about what each one actually means for a regular investor. The first pathway is business development companies, known as BDCs. BDCs are publicly traded companies that lend money to mid-sized businesses using the private credit model. You can buy BDC shares on any stock exchange, exactly like buying Apple or Microsoft. Examples include Ares Capital Corporation, Blue Owl Capital Corporation, and Goldman Sachs BDC. This is the most accessible entry point. Anyone with a standard brokerage account can get in today. The trade-off. BDCs are publicly traded, which means their price moves with the stock market. You do not get the same insulation from market volatility that direct private credit funds offer. The second pathway is interval funds and semi-liquid funds. These are private credit funds that allow limited redemptions, usually quarterly or annually. They are more accessible than fully locked-up private funds. According to Morningstar data, assets in semi-liquid credit funds climbed to $230 billion by mid-2025, a 22% increase in just 1 year. Platforms like iCapital and CAIS are making these available to high-net-worth individual investors with lower minimums than traditional private funds. The third pathway is ETFs that track private credit adjacent markets. You cannot buy pure private credit through a standard ETF yet, but there are ETFs that give exposure to floating rate loans and business development companies. This is the most liquid and lowest barrier option, but also the most indirect exposure. The fourth pathway is direct fund access for accredited investors. Firms like Blackstone, Apollo, and Ares offer private credit funds directly to accredited investors, typically requiring a minimum of $250,000 to $250,000. And with a new executive order on 401k plans, a fifth pathway is beginning to take shape that could eventually make private credit accessible to tens of millions of ordinary Americans through their retirement accounts. So let me bring everything together. Private credit is a $3 trillion market, growing toward $5 trillion by 2029. It was built on a simple premise. After 2008, banks were forced to pull back from lending. Companies still needed capital, and private lenders stepped in, offering speed, flexibility, and certainty in exchange for higher interest rates, earning returns of 9 to 13% that banks used to keep entirely for themselves. For over a decade, only institutional investors had meaningful access. Pension funds quietly earning double-digit returns on your retirement money. Insurance companies compounding their clients' premiums at high yields. while regular investors were told to be satisfied with savings accounts and index funds. But that is changing through BDCs, semi-liquid funds, and now the opening of 401k plans to alternative assets. The walls are coming down. Is private credit risk-free? Absolutely not. Is it liquid? No. Does it require patience, long time horizons, and careful manager selection? Yes. But here is the question I want to leave you with. If the system that manages your retirement money has been investing in private credit for years and earning significantly higher returns than what your own personal savings earns, is that something you are comfortable with? Or is that something you want to understand better and start making more informed decisions about? Because the people who understand where money actually flows are always better positioned than the people who just watch it happen to them. That choice is yours right now. If this video changed how you think about money and where it actually goes, hit subscribe. Because every single week, we break down the biggest financial systems on the planet in the simplest language possible. See you in the next one.